Welcome to the Apartment Investors Show, where we help you get smart and invest smarter in multifamily real estate. I am your host, JC Castillo, founder and managing principal of the Multifamily Property Group. And joining me as always is my good buddy, my co-host, the godfather of lending, Mr. Paul Peebles, national underwriter for Old Capital Lending. Paulie, how are you doing today?
We're doing great. We don't have the fires that Northern California has, but I'm sure that you guys are scrambling quite a bit. But I'm excited about this show today, and the reason being is that you see all the firefighters going down the street in their big red engines or yellow engines, and you see the fire lights going on. Well, that's a little bit how I see Northern California today, and through the pandemic and all the craziness that's going on within the state itself, whether they're thinking about doing a wealth tax or increasing the state income tax, or just the craziness of people living in the city and rents. And so, we are excited today to have probably one of the eminent multifamily gurus up in the Bay Area that works for a company that we have done a lot of business with in the past. They're really based out of Houston, Texas. And we do a lot of business with these guys, and we think very highly of this group. And so, JC, will you introduce our guest?
Absolutely, Paul. We do not like to listen to talking heads, as we like to say. We like to get our information from the experts. And so today what we figured we would do is give all of our listeners a little treat and talk about the San Francisco Bay Area multifamily real estate market and what's going on with COVID-19 and San Francisco Bay Area real estate. So today we want to welcome to the show Mr. Shivu Srinivasan of Transwestern Transwestern Commercial Real Estate. So Shivu, welcome to the show, and thank you so much for joining us, man.
Yeah, thank you guys. Thank you, Paul. Thank you, JC, for having me. Definitely excited to be here and kind of share some insight into the market. I know you guys operate almost in a different universe out there in Dallas. Lots of differences between multifamily apartments, regulations, laws, et cetera. So, I'm excited to kind of share with you guys some insight in this, post-pandemic world we're in, or still currently in a pandemic. We're seeing, a lot of shifts, a lot of changes out here in what is usually a very bulletproof real estate market. So
let's talk a little bit about that, because I almost want to be like Fox News. Let's make it fair and balanced. And talk to me about the multifamily business. Talk to me about just a couple of things that are positive of what's going on in the multifamily business in California, especially up in the Bay Area. And then talk to me about some of the things that are kind of negative that you just want to make sure that sellers are aware of about what's going on in the Northern California area, and kind of give us a background. What is the Bay Area? Where does your territory start and end?
Yeah, so we cover the Bay Area, primarily the East Bay and also the I-80 corridor up to the state capital of Sacramento. We've also started to kind of prospect over the past year into the some of the Central Valley markets, such as Modesto, Stockton, Tracy, more suburban type markets. So, we're seeing a lot of growth and pressure from the Bay Area spilling over into some of these what are traditionally secondary or maybe even tertiary markets. And there's been a flight of capital from the Bay Area to some of these other locations. And it's kind of like a microcosm of what's happening on a national level. Maybe money's leaving California, going to Texas or Denver, Salt Lake City. If you kind of shut that down into this region, we're seeing money going from the Bay Area to Sacramento or to Stockton, Modesto. We specialize in multifamily. I run a 4-man team. My average listing right now is about $10 million. I got guys on my team who do some smaller stuff. We are also, working on some larger deals as well. Those are the territories we cover. As far as, the pros and cons right now at this current time, I think the Bay Area has always kind of been the gold standard of national multifamily, given the sky high rents you can get here. I think right now we're kind of seeing a dramatic kind of shift in lifestyle choices, and people are rethinking how they live and where they want to live, and urban centers, densely populated areas right now are not very popular. A lot of people are moving out, going to these more suburban markets. So I think there's pros and cons to both of those things. If you look at Sacramento, maybe similar to Dallas in many ways, over there, we're still seeing strong rents and values holding steady. Maybe even price per door is going up because of these ultra low interest rates we're seeing. The interest rates have compressed more than the cap rates have compressed after the pandemic. So maybe cap rates have adjusted slightly upwards, but the interest rates have adjusted downwards. So in a way, we are seeing those markets somehow are appreciating even a little bit. And then here in the Bay Area as well, we're seeing a shift given the regulations. Maybe the boomers or the people who've been in business for a longer time who want to be more hands-off or going out of state. But nevertheless, there's no doubt this is also an incredible buying opportunity for the new age of investors, the younger guys who are willing to roll their sleeves up and get their hands dirty. So I think there's pros and cons on both sides. It's a good time to sell. It's also a good time to buy.
Fantastic. Let's talk a little bit about, say, rent control, about what's going on. You guys kind of led the way, Sacramento did last year, about trying to implement rent control throughout the state. What type of an impact have you seen on rent control up in your territory?
Yeah, well, rent control is nothing new in the Bay Area, especially in some of the cities that I first started brokering in. Oakland, for example, has one of the most stringent rent controls in the entire state. Oakland, Berkeley, San Francisco. So for us, it's nothing new. For a lot of the bigger institutional kind of national players, we're seeing a lot of those guys are being more cautious. They have been more cautious. There's a bill, AB 1482. They instituted essentially what equates to about an 8% cap on annual rent hikes, which most people said, that's probably fine. But the issue is that this is kind of a never-ending battle. Now that they got in the 8% rent cap, they're going to want 5%, then they're going to want 3%. So it's always this constant battle that I don't see ending anytime soon. Housing is always going to be a shortage here in California. With the virus and the pandemic, there have been a lot of emergency ordinances that have been put in place. And I think rightfully so. A lot of these people, through no fault of their own, have lost their jobs or their income, and they do need protection. What is slightly concerning, though, is a lot of the local city councils, they're moving to make some of those ordinances more permanent. And that is causing concern amongst a lot of landlords.
So Shivu, if I'm an owner, let's say in San Francisco right now, and I've got a property in that vicinity, and I'm getting pretty concerned about these sorts of things happening. What are some of the words of wisdom that you would impart to these folks out here with real estate in those markets?
Yeah, I think everybody's kind of maybe at a different stage in their investment career. Like I said, if you're maybe a kind of older generation who's already put in all your sweat equity and now you just kind of want to ride off into the sunset, still have some secure income, I think there's no doubt the writing's on the wall. It's time to get out. It's time to sell. It's time to go to a less regulated state where you can have a bigger footprint when you look at a price per door or a cap rate. You can have higher cash flow and own more units. So there's no doubt in my mind for that generation, it's probably time to move. And I think this virus is kind of accelerating that through, not only the economic downturn, but also the population shift from these markets to those markets. So that would be my advice, and then to the younger people as well, I would say, money's basically free right now. We went from a low interest rate environment to an ultra low interest rate environment. So if you look at the last recession, a lot of the most successful industry leaders kind of they built their business in 2010, 11, 12. So I think over these next couple of years, you're going to see some incredible opportunities to invest. And I think the guys that are going to be aggressive and look to still deploy capital are going to look real smart in 5 years.
as they say in investing, you can't get hurt by taking profits. You can't get hurt by taking profits. So if there's large profits that you've already made, maybe it's time for you to sell and do an exchange into some other area that may be landlord friendly. So maybe JC has some answers for that that part. But I am concerned about what's happening to the Bay Area. I was in a conversation with a buddy of mine that lives over in the San Jose area that, he rents, and he has been renting for a long period of time. He's a smart guy. His lease was coming up, and his lease at an A-class building that they just wanted him to continue to pay next year the same rent he was paying this year. He was like, well, people that are coming in are getting a discount. I want to get that same discount. Oh, no discount on that. No, I want to get the discount or I'll just move out. And they said, oh, well, if you're serious now, maybe we will discount it. So they discounted by $700 a month in less rent. And if you multiply that out by 12 months and multiply that by the number of units in that property, and that all of them are going to turn, that's a large concern that I had in what's going on. So I think I kind of go back that if you've gotten your profits, maybe it's a good time to take those and possibly sell down the road. JC, what's your take on that?
I live in San Jose, and so Shivu and I are Bay Area people, and I agree with you that we're seeing the same things out here that Shivu and you are talking about. That is that a lot of people are choosing to move out to the suburbs rather than stay in these urban centers, which actually, for the most part, have been a little bit dead because of the pandemic anyways, and people are already working from home. So if they can save themselves, several $100s a month by moving out of the city, even if it's on a temporary 1 year, 2 year basis, they're going to do that. So, there's definitely been huge rent drops that have been sort of felt almost instantaneously, which is unheard of in the Bay Area market. I mean, Shivu, what I'm curious about is, what does all this mean in the temporary sense? And I think that it could be a great buying opportunity in the Bay Area, but what does it mean for somebody that's actually got a deal in the market right now? What are you seeing in terms of valuation differences pre-pandemic and post-pandemic here in a city like San Francisco or Oakland?
Yeah, absolutely. We have about $70 million listed right now. The people that are still active looking to deploy capital, they're all pretty much saying the same thing. They're looking for probably around a 10% discount. When you look at a lot of our listings, and some are even less. I would say that, the more kind of denser location, closer to the core, are taking a bigger hit. So we have about $35 million listed in Oakland. We're seeing about a 10% reduction there. But if you go out to some other markets, maybe it's not quite 10%, but probably between 5 and 10%. But I think when you look at the overall state of the economy and you look at what's really happening out there, a 5 and 10% discount is not bad at all. In fact, I would argue it's really good considering the context. So we're just coming out of a 5 or 8 year boom for valuations. So I know it's kind of hard for a lot of people to digest, hey, my property is worth 10% less overnight. But I still think it's a good time to sell because I do think this recovery in the urban areas is going to take a couple of years. I think next year is going to be really tough. I think potentially tougher than the situation right now. And I do know one thing, interest rates can't get any lower. So there is some risk, although it might be very small, that maybe interest rates, climb at some point. So I think the low rates are keeping the valuations within that 5 to 10% range. If rates were closer to what they were pre-pandemic, that number would be bigger. So if you're somebody that's thinking about selling, I think you still get out now, get a good price. From what I hear, a lot of these other markets, whether it's Dallas or Denver or Salt Lake City, their rents are holding steady. I've heard in Boise, they're actually going up. So
the rest of the United States is not like the Bay Area right now. In Dallas or Texas, I can kind of speak to that specifically. Now, there are some challenges in some of the lower class C properties, but in the B and the C pluses, rents are stable. There is no COVID-19 discount when it comes to to property values. And you're absolutely correct. The discount really has come in the form of the capital markets, where rates were at 4.25 last year. I mean, they're at below 3. So I don't know, the banks are not going to pay you to buy a multifamily property, but you're absolutely correct, Shivu. It is pretty damn low right now, especially if you could do non-recourse and get up to, say, 80% leverage in some of these markets outside, where in Northern California, you had to put down 35 or even 40%. Who are the buyers coming in right now and looking to buy in the area? And how big of a disconnect is it between the sellers that think this is just temporary versus the people that are thinking that, no, this could be a permanent deal?
Yeah, I mean, I think you still see a lot of mid-market, kind of not quite institutional, but a level below that. These kind of $10 to $30 million players who have their group sponsors, their syndicators. They have high net worth individuals who are sitting on cash, and the cash isn't earning anything in the bank. So those guys, they have money to deploy. They want to take advantage of these low rates. So I think those are the guys being the most active. From what I'm hearing from the institutional guys, they're much more cautious. They're deploying large sums of capital into every deal. So understandably so, it seems like they kind of want to wait it out a little bit and have some more.
In the B and C market that you guys kind of specialize in, are you seeing a lot of overseas money coming in to say, this may be just a temporary deal for a year or 2 or 3, but I think I want to deploy cash if I'm coming from Hong Kong or if I'm coming from other areas of the world to kind of specialize in that great San Francisco Bay Area?
Yeah, I mean, I think in the Bay Area, there's always kind of overseas money coming in. I'm not sure necessarily that it's increased or decreased. I can't say with any certainty. But what I can say is all the capital that's out there, there still is a lot of capital, but they're all kind of looking for this kind of 5 to 10% discount. So, I think the U.S. overall is still kind of the place you want to invest your money in. Even though we might be struggling right now, I do think in a few years the real estate market will continue on an upwards climb. And in many ways, while valuations certainly could be down, even here in the Bay Area, one argument I've heard from investors and buyers is, relatively speaking, these assets are actually appreciating on a yield basis. Because if you look at the adjustment in the cap rate, it's a smaller adjustment than what we're seeing as far as rents coming down, as far as delinquency going up, right? So it's not a one-to-one adjustment. The cap rate isn't fully moving to compensate the buyer for all that lost income. It's only partially compensating them. So from a yield perspective, you could argue that the property is actually kind of appreciating when you look at the percentage of that yield.
I used to see a lot of buses leaving Facebook and delivering folks up into San Francisco or going across the bridge over to the North Bay area. Are you still seeing the folks on the buses, or they kind of decided, listen, I'm not staying in the city anymore and I'm moving out?
Well, everybody's working from home, so I'm sure the buses are, maybe there's some essential people, software or hardware engineers more likely that still need to go into, IBM or Intel or these kind of companies. But for the most part, Google, Salesforce, they've all told their employees they don't need to come to the office till at least summer 2021. So, we're everybody
just kind of winding down this conversation. And JC, I'll ask you this question. I mean, are you seeing people that maybe have gotten a huge amount of profits that came out of the own real estate in San Francisco for 20 years or so to kind of go to safe shores and into another area of the country, and then buy something over there, and then possibly just wait it out, and then maybe come in the next 2 or 3 years, maybe come in and rebuy in Northern California? What's your take?
Yeah, Paulie. I mean, I think that we have definitely noticed it as a company, and being in this business for a while, I definitely have seen an uptick of high net worth people that are coming out of exchanges with big capital gains coming out of California and wanting to go to out of state markets because of the more business friendly / we'll call it landlord friendly atmosphere for real estate investing. And so I think that one of the challenges that a lot of these investors face, and we talk to them a lot, is that they really know the Bay Area market backwards and forwards, and so there's a comfort level there. And so when you talk about a person that's owned in one market for 20 or 30 years, and suddenly now they realize the writing's on the wall and they've got to go out and go outside of their market, it's almost like a pioneer going west, except now they're going east. And there's a lot of fear, uncertainty, and doubt that they have. So what we try to do as a company is really let them know that we can help advise them, because we've been investing out of state as a company that's based in California for 14 years now. So we really act as an advisory company to sort of help show them not only what's out there, but also the knowledge of how to make the deal work and operate so that they can be a little bit more hands-off as sort of people that are riding off into the sunset themselves and looking for more of a passive style approach to their investing. So, Paulie, we definitely have seen an uptick, and we are here as a company really to sort of service and help in an advisory role those people and those clients to really place their money in other markets where they can sort of sit back and have a relatively less involved experience as a real estate investor.
Shivu, let's finish it off here. And then any good words of wisdom right now that when you pick up a phone and are talking with a potential seller of a property, what are you kind of leading with and telling them? And then let's just ask that first question.
Yeah, I mean, I think, again, it kind of boils down to each individual's investment goals. And if a lot of people are just kind of getting a little tired of hands-on management, then I've introduced, I think, a couple people to JC this year. And I think I'll probably be introducing a lot more people to JC here in the next couple months. But yeah, I think going into a kind of a group deal or group sponsor deal as an LP is pretty appealing, because we saw this huge demand for kind of triple net property over the past few years, which obviously right now is very shaky with the changes we're seeing to retail. So going into a market with somebody like JC, who really knows what he's doing, and you're a silent guy, you're an LP in a way that's almost like a triple net. You're not doing anything, and you have the expertise of somebody who knows it all and who's done it all. And JC, I know, always has skin in the game. He always invests his own money into every deal, so he's just not out there trying to take people's money and run away with it. He's really finding good deals. And correct me if I'm wrong, JC, but I know a lot of these kind of group deals are structured so that the more money the LP makes, the more money the GP makes. There's kind of a tiered system there, so you're kind of incentivized to help people find great deals. Is that kind of how we call that investor sponsor alignment of investment interests. So, and we're big believers in making sure that we make money when the investment capital partners make money. So yes, that's definitely an approach there.
So we do appreciate you being in the podcast. I know that we've come to the end here. So if somebody wanted to get more information, Shivu, from you about what's going on in the Bay Area, maybe they have a property that they'd like to sell, or maybe somebody would want to buy, what's the best way for them to get in contact with you?
Yeah, they could just, they can look me up on LinkedIn. My name is Shivu Srinivasan, or they could probably email me would be a better way to do it. It's just my first name, Shivu, that's SHIVU @transwestern.com. Shoot me an email, set up a time to chat. Happy to connect with anybody, answer any questions, give them my 2 cents on what's going on out there.
That's great. Shivu, we certainly do appreciate you spending some time with us. That was JC Castillo. And I'm Paul Peebles. Have a great day.